Welcome back to the Crypto Intellect, where we cut through the noise, ignore the hype, and focus on what's really happening in the crypto market. Today, we're diving into one of the biggest XRP stories making the rounds right now. You've probably seen the headlines already. Some are claiming XRP could reach $2,000 per coin. Others are calling it pure fantasy. Meanwhile, behind all the excitement, something much more important is quietly unfolding. Over the next several months, roughly $1 billion could be directed toward acquiring XRP, and much of that buying pressure may come directly from the same open market that everyday investors use. That means the story isn't just about a giant price prediction. The real story is about supply, demand, institutional accumulation, and what happens when large patient investors begin removing significant amounts of XRP from circulation. While social media focuses on eye-popping numbers, smart investors are asking a different question. What is actually happening underneath the surface? That's exactly what we're going to explore today. By the end of this video, you'll understand why some major players are betting heavily on XRP, why the phrase "off the open market" matters so much, and whether the famous $2,000 XRP prediction has any realistic foundation at all. Before we go any further, I want to make something very clear. Nothing in this video is financial advice. We're discussing large numbers, bold forecasts, and major developments. But your financial decisions belong to you alone. The crypto market has a way of pulling people into emotional extremes. One day, everyone believes they'll become millionaires overnight. The next day, everyone thinks the sky is falling. The truth is usually somewhere in the middle. Whenever you hear extraordinary claims, whether they're bullish or bearish, it's important to step back and look at the facts calmly. That's what we aim to do here on this channel. We're not interested in selling dreams. We're interested in understanding reality. So if you hear a price target that sounds unbelievable, don't immediately accept it and don't immediately reject it either. Instead, ask what assumptions must be true for that prediction to happen. Ask who is buying, who is selling, and how the market structure is changing. Those questions often reveal far more than any flashy headline ever could. With that mindset in place, let's start unpacking what may be one of the most significant XRP developments we've seen in years. The first piece of this story revolves around a company that many investors are only beginning to learn about. This company was created with a very specific mission: to become one of the largest public holders of XRP in the world. Unlike a traditional technology company or financial institution that happens to own some XRP, this organization is being built around XRP itself. Its primary goal is accumulating and holding a massive treasury of the asset. What makes this especially interesting is that it plans to operate within the public markets, giving traditional investors exposure through familiar brokerage accounts rather than requiring them to manage wallets, private keys, or crypto custody solutions. For years, many institutional investors remained on the sidelines because of these barriers. This structure could potentially remove some of those obstacles. Instead of buying XRP directly, investors could gain indirect exposure through shares of a publicly traded company whose primary asset is XRP. That may sound like a small distinction, but in the world of institutional finance, accessibility often determines where money flows. The easier an asset becomes to access, the larger the pool of potential buyers becomes. What really grabbed attention, however, wasn't just the company itself. It was the size of the capital commitment behind it. Reports suggest that more than $1 billion has been lined up to support this strategy. That's not the kind of money that appears by accident. When billion-dollar commitments emerge, investors naturally begin asking who is involved and why. The names connected to the project have added even more intrigue. Some of the individuals associated with the effort have deep roots within the XRP ecosystem and the broader crypto industry. These are not unknown traders chasing the latest trend. They are experienced participants who have spent years building businesses, navigating regulatory challenges, and working within financial markets. Their involvement doesn't automatically guarantee success, but it does signal that serious people see potential in this strategy. When sophisticated investors commit substantial capital, it's usually because they believe there is a long-term opportunity worth pursuing. Whether that opportunity ultimately pays off remains to be seen, but the scale of the commitment alone deserves attention. One detail in particular has generated enormous discussion among XRP supporters. Most of the planned purchases are expected to come directly from the open market. At first glance, that may not sound especially dramatic. After all, people buy XRP on exchanges every day, but the implications become more interesting when you think about what happens afterward. If a company acquires large amounts of XRP and then holds it as a long-term treasury asset, those tokens effectively leave active circulation. They aren't being traded back and forth every day. They aren't immediately returning to exchanges. Instead, they become part of a strategic reserve. Multiply that process across hundreds of millions of dollars in purchases, and you begin to understand why some analysts are paying close attention. Markets are influenced by supply and demand. When available supply decreases while demand remains steady or increases, prices often face upward pressure. It's not a guarantee, but it is a dynamic that investors cannot ignore. This is why those three words, off the open market, have become such a central part of the conversation. To understand the potential impact, it helps to think about XRP's supply structure. On paper, the total supply appears enormous. However, not all XRP is actively available for trading at any given moment. Some is held in escrow arrangements. Some is owned by institutions. Some sits in long-term wallets belonging to investors who have no intention of selling anytime soon. In other words, the amount of XRP that is truly liquid and available for immediate purchase is much smaller than the headline supply number suggests. Imagine looking at a giant warehouse full of inventory, only to discover that most of the boxes are locked behind doors that rarely open. Technically, the inventory exists, but practically speaking, much of it isn't accessible. That distinction matters. If large buyers begin competing for a relatively limited pool of available XRP, market conditions can tighten surprisingly quickly. This is one reason why institutional accumulation stories tend to attract attention. They force investors to reconsider how much supply is actually available and how that availability may change over time. Another important aspect of this story is that it may not remain an isolated case. History shows that once a financial strategy proves viable, others often follow. We saw this phenomenon play out in the Bitcoin market. Initially, the idea of public companies holding large cryptocurrency reserves seemed unusual. Over time, however, it became increasingly accepted. As more organizations adopted similar strategies, what once looked experimental started appearing normal. Some XRP supporters believe a similar pattern could emerge here. Several companies have already announced XRP-related treasury initiatives of varying sizes. Individually, none of these efforts may transform the market overnight. Collectively, though, they could represent the beginning of a broader trend. If additional firms decide they want XRP exposure on their balance sheets, competition for available supply could intensify. Again, this doesn't guarantee extraordinary price appreciation, but it does create conditions worth monitoring. Financial markets often change gradually before they change dramatically, and the earliest signs are sometimes visible long before the broader public notices. Now we arrive at the part of the discussion that has captured the internet's attention, the famous $2,000 XRP prediction. Whenever a number that large appears, emotions tend to take over. Supporters celebrate, critics laugh, social media explodes, but neither reaction tells us much about whether the prediction is actually realistic. The more useful approach is to examine the underlying math. XRP currently has tens of billions of tokens in circulation. Multiplying that supply by a $2,000 price produces a market capitalization that would dwarf nearly every financial market on Earth. We're talking about numbers so large that they challenge conventional economic assumptions. That doesn't automatically make the prediction impossible. Markets can evolve in unexpected ways. However, it does mean the burden of proof becomes extremely high. Extraordinary valuations require extraordinary explanations. Investors should understand the scale of what is being proposed rather than focusing solely on the excitement generated by the headline figure. The analyst most frequently associated with these ambitious XRP forecasts is Jake Claver. Like many outspoken market commentators, he has attracted both loyal supporters and vocal critics. His bullish outlook is based on the belief that XRP could eventually play a major role in global finance, cross-border payments, and tokenized asset markets. Those are legitimate themes worth discussing. The challenge arises when long-term possibilities become attached to highly specific price targets. Predicting future adoption trends is difficult enough. Predicting exact prices years in advance is even harder. Financial history is filled with forecasts that sounded convincing at the time, but failed to materialize. That doesn't mean analysts should stop making predictions. It simply means investors should treat those predictions as scenarios rather than certainties. A forecast can be useful for stimulating discussion without being treated as a guarantee. The problem occurs when people stop questioning assumptions and start treating speculation as fact. What often gets lost in these debates is that you don't need a $2,000 XRP to justify interest in the asset. Even far more modest outcomes could represent substantial growth from current levels. This is where expectations become incredibly important. When investors spend months focusing on enormous price targets, smaller but still meaningful gains can feel disappointing. Imagine an investor convinced that XRP will reach four figures. If the asset rises several 100% instead, that person may still feel frustrated, despite achieving a result that most investors would consider remarkable. Unrealistic expectations can distort perception. They can make real progress seem insignificant. That's one reason why it's important to separate the underlying trend from the headline number. Institutional adoption, expanding infrastructure, and increasing utility can all be positive developments, regardless of whether XRP ever approaches the most extreme predictions circulating online. Investors who maintain realistic expectations often find it easier to navigate market volatility and make rational decisions. At the same time, it would be irresponsible to discuss only the bullish side of the story. There are genuine risks and uncertainties that deserve attention. Large treasury strategies still require execution. Regulatory environments can change. Market sentiment can shift unexpectedly. Economic conditions can influence investor behavior. Even companies pursuing ambitious XRP accumulation plans face challenges. Shareholder approvals, operational hurdles, financing considerations, and broader market conditions all play a role. Furthermore, owning XRP and owning shares in a company that holds XRP are not the same thing. Investors sometimes assume that success in one automatically guarantees success in the other. Reality is often more complicated. Understanding these distinctions is crucial. Strong narratives can create excitement, but successful investing usually requires looking beyond the narrative and evaluating practical risks. The most informed participants are often those who consider both the opportunities and the obstacles. Stepping back from the price discussion entirely reveals something perhaps even more significant. XRP's reputation appears to be evolving. For years, conversations about XRP were dominated by regulatory battles, lawsuits, and uncertainty. Those issues shaped public perception. Today, however, the conversation increasingly includes infrastructure, institutional participation, treasury strategies, tokenization initiatives, and payment systems. That doesn't mean every challenge has disappeared. It does suggest that the narrative surrounding XRP is becoming broader and more sophisticated. Financial markets often reward assets that transition from speculative stories into functional ecosystems. Investors are paying attention not only to price action but also to what is being built behind the scenes. Whether it's treasury companies, payment solutions, stablecoin integrations, or blockchain-based financial products, the focus is gradually expanding beyond speculation alone. This shift toward infrastructure is one of the strongest arguments made by long-term XRP supporters. Their case isn't simply that the price will rise. Their argument is that XRP is becoming increasingly integrated into systems designed for real-world financial activity. If that trend continues, they believe demand could grow in a more sustainable manner than demand driven purely by speculation. Infrastructure stories tend to develop slowly. They rarely produce instant results. Instead, progress accumulates over time through partnerships, integrations, regulatory developments, and technological improvements. Investors seeking immediate gratification often overlook these gradual changes. Yet some of the largest market transformations in history began with exactly this kind of slow, incremental progress. Whether XRP ultimately follows that path remains uncertain, but the possibility explains why institutional participants continue paying attention. Another factor worth considering is psychology. Markets are not driven solely by numbers. Human behavior plays a massive role. When investors see respected institutions entering a market, confidence often increases. Perception matters. If large organizations begin treating XRP as a legitimate treasury asset, other participants may reevaluate their own assumptions. This doesn't mean everyone will suddenly rush to buy. It means the conversation changes. Assets once viewed as fringe opportunities can gradually gain credibility. Credibility attracts attention. Attention attracts capital. Capital influences markets. The process is rarely linear, but it can be powerful. Understanding these psychological dynamics helps explain why institutional developments often receive so much coverage. The direct purchases matter, but the signal those purchases send can matter just as much. As we look ahead, the key question isn't whether XRP will hit $2,000 next year. The more important question is whether the structural changes currently underway continue gathering momentum. Will additional companies adopt treasury strategies? Will institutional participation expand? Will utility and infrastructure continue growing? Those developments are measurable. They can be tracked through filings, partnerships, announcements, and market activity. Unlike speculative price targets, they provide tangible evidence of progress. Investors who focus on these indicators often gain a clearer understanding of where the market may be heading. Instead of chasing headlines, they watch trends. Instead of reacting to every prediction, they evaluate underlying fundamentals. That approach may not be as exciting as viral price forecasts, but it often proves more valuable over the long run. When you strip away the noise, the real story becomes surprisingly simple. A significant amount of capital appears poised to accumulate XRP. Much of that buying could occur directly from the open market. Long-term holders and institutions continue removing supply from active circulation. More organizations are exploring ways to build financial products around XRP. These developments are real, documented, and measurable. By contrast, the most extreme price predictions remain speculative. They are possibilities discussed by analysts, not guarantees supported by established facts. Understanding the difference between those two categories is essential. One represents observable market behavior. The other represents future projections. Both deserve consideration, but they should never be treated as equal forms of evidence. So, when someone asks whether the $2,000 XRP target is realistic or just hype, the honest answer is more nuanced than either side wants to admit. The exact number may be extraordinarily difficult to justify using today's market conditions. Yet the forces driving interest in XRP are very real. Institutional accumulation is real, treasury strategies are real, infrastructure development is real, supply dynamics are real. Those factors may ultimately prove far more important than any single forecast. While others focus on sensational headlines, experienced investors often pay attention to what money is actually doing. Right now, some very large players appear to be positioning themselves around XRP. Whether that leads to modest gains, substantial appreciation, or something in between remains unknown. What matters is understanding the trend rather than getting lost in the hype. Thank you for watching The Crypto Intellect. Stay informed, stay patient, keep questioning every headline you see, and I'll see you in the next video.